Apple's down a lot from its high of 180, guys. It's down so much that even Warren Buffett has loved it. He started to build a position. When it dipped into the 130s, I believe, he started to buy it. As it went higher, he stopped buying it. But Apple, to me, will be a good metric for where this market's going. When people have given up on Apple, that's when I think we would have hit a bottom in the market. That has not happened yet. Apple, Tesla, Amazon, these are the stewards of this market. We're going to watch those. If you're new to this channel, I'm Paul. My goal is to teach value investing. I believe that the more you learn, the less you will fear. And I also believe in calling out what I perceive to be the scam artists of the YouTube world. Make sure you find people who are teaching you a process and not just people who got lucky on a few stock picks and made a career out of it. So let's go use our software. If you're a member of our software, please follow along. Let's go to stock search and let's go to Apple. So we type it in there, boom, we pull it up right here. Our 8-pillar process worked very well for us. Like I said here, 52-week high of 183, 52-week low of 130, and the stock is currently trading at 147. My guess is Warren Buffett's not buying it at 147 because I believe in the past when it was 150 or so, he wasn't buying it, but who knows? We'll find out in his next 13F. So the 8-pillar process. First pillar, we want the 5-year PE to be under 22.5. So on this main page, left-hand column, 5-year PE, 34.71. That's an X. All right, so seems high, but again, a PE should be based on future growth potential and moat. And I think we all agree that Apple has quite the moat. Pillar number 2, we want the 5-year return on invested capital being greater than 9%. Main page, 33.4%. This company does an amazing job reinvesting the money that is in the business through debt and equity. All right. Pillar number 3, very simple. We want revenue growth over the last 5 years. So we scroll to the top, go to the income statement. Boom, right here. 5 years ago, 247.4. Last year, 386. Check mark there. Pillar number 4, we want net income growth positive. That's it over the last 5 years. So we scroll down a little bit. 5 years ago, they made 53 billion. Last year, 101 billion, almost double. Now, 6 or 7 years ago, somebody reached out to me and said, Paul, what do you think of Apple from a value play? It was a screaming value play, but I didn't buy it. Where was my flaw in my analysis? I didn't think they could grow that much more that quickly. I was clearly wrong, but that's my usual mistakes or mistakes of omission, not commission. What that means is I tend to exclude companies I should have bought. I don't tend to buy companies that I should have never, ever bought. This is where I missed my mark here. I thought, how the heck they beat these 4 years? Well, very easily. They do this. They crushed it. Guys, I was just in New York City this weekend with my fiance for my birthday. We were walking next to the hotel at night, and there's the Apple store. It's an underground Apple store. I walked up to the security guy, said, hey, when do you guys close? Sir, we're 24 hours. I was like, this is incredible. Went downstairs. It was busy. People were helpful. You were able to buy anything. We had a screen protector, changed out. I was looking at the iPhone 13 Pro, etc. It was incredible. This is what makes Apple amazing. They're customer oriented, and they make a ton of money. And unlike other tech companies in the past, you're immersing your life into Apple. That's how they're going to keep you on Apple products for a long time. And that's what I love. So, pillar number 5, we want the shares outstanding staying the same or decreasing because we don't want share dilution. When a company increases the number of shares they have, they are diluting you as an owner. You own less and less of the business as time goes on. We don't want that. So we scroll down to the income statement. We go to the end of the 6th year, 20.9 billion, 16.28. Check mark there. Shares are decreasing. Now, they are buying back expensive shares, which I don't like, but they're generating so much cash flow, it's really difficult to kind of put that to use. So I can somewhat buy into that. Pillar number 6, we want to look at their long-term liabilities, essentially their debt, because debt works for a company the way it works for you as a person. If you and your neighbor are exactly the same people, same income, same home, same everything, but they have 10 million in debt, you have 0, who is more likely to have financial trouble? Of course, them. Same thing with a company. So what do? We go back to the main page. We look at their 5-year average free cash flow. We multiply that by 5. So 75 billion times 5 is $375 billion. So we want their long-term liabilities to be under $375 billion. So we go up to the balance sheet, scroll almost to the bottom. Total long-term liabilities, $155 billion. Less than half of that number. Now, pillars 7 and 8, we're going to explain more about the cash flow. So free cash flow is cash from operations less your capital expenditures. You can do one of 5 things with free cash flow. Buy back shares, pay down debt, pay dividends, reinvest back in yourself, or make acquisitions. You can do any combination of those 5. It's quite simple. Just like your free cash flow, they have free cash flow. All right? So how do we calculate it? Well, luckily for you guys in our cash flow statement, instead of making you do the math, we just add the line right here. Boom, free cash flow right here after your capital expenditures. 54.7 to 105. Check mark there. So our final metric, Just like the PE, we want some sort of multiple of free cash flow to give us a market cap for the company that we want to buy at. So we take the 5-year average free cash flow, call it $75 billion. We multiply it by 22.5. 1.5 plus 150, 1.65, call it $1.7 trillion. It's actually 1.68 or 1.69 trillion. 1.7 trillion. So we want Apple's market cap to be under 1.7 trillion. So if you remember, on the main page, main metrics, we have 2.4 trillion as a market cap. So it's expensive. Now, guys, there's a lot of math I've thrown here. For those of you who subscribe to the software, you've seen this 1,000 times, and you automatically probably go to the 8 pillars tab. It's right here all the way for you. X was the first one, X was the last one, everything else was a check in between. Now, does that mean because there's 2 X's here, you shouldn't buy it? Not necessarily. There are other parts of the company, whether they're growing a lot, have a great moat, can get a higher return on their invested capital like Apple can, you can justify paying a higher price. So how do we determine that? Well, we go to the stock analyzer tool. This is our most popular part of our website. It allows you to make the assumptions about the future and determine what price to pay for the company based on those assumptions. All right. Before we do the stock analyzer tool, I want you to pay close attention because this will make a lot more sense. When we started this channel, I was using an Excel sheet with a data feed. And everybody who watched our videos, if you go back, people would write in there, how do I get the Excel sheet? So we said, you know what? Let's just create the software. This is the software I use every single day to analyze my own companies. It gives you so much more than just the financial statements. First off, it gives you 30 years of financial statements. It gives you the stock analyzer tool, which if you're new to our channel, when you see it right now, you're going to be blown away by how awesome it is. But most importantly, it gives you our community. This is a community of over 12,000 people who have signed up for the software in the last year and a half. It lets them engage and have conversations of like-minded people. Because the thing we found was it was much easier to be a value investor when you had a like-minded community around you. When you're on your own on an island that nobody agrees with you, it's easy to fall for the other traps of the media and things like that. But when you're in this community and people are all talking the same talk, it's much easier to have much more like-minded conversations. And the best part is this is all available for less than a cup of coffee per day. This will literally change lives, increase your net worth potentially by hundreds of thousands, if not millions of dollars, just by following the process that works. We do way more in here. We do book clubs. We do quotes of the day. We do exclusive content every single day just for people in the community. And it's such a well-done chat. 2 ways to sign up, everythingmoney.com or patreon.com for international users. But guys, it's less than a cup of coffee a day and it could lead to millions. Sign up now. So now a stock analyzer tool. This is your way of figuring out what to pay for a company once you've made assumptions. All right. So the first assumption I'm going to do is 10 years of analysis. You can do 1 to 20. Here are the revenue growth, profit margin, and free cash flow numbers of the company over the last 1, 5, and 10 years. Use these as kind of a guiding light for yourself going forward. Okay. So for revenue growth, yes, it's grown a lot. But the bigger and bigger it gets, it's harder and harder to grow. Yes, I made that mistake 5 years ago, but I'm going to continue making reasonable low assumptions. So I'm going to do 3, 5, and 7% revenue growth. Profit margin, I'm going to do 21, 22.5, and 24. Free cash flow margin, I'm going to do 23, 24.5, and 26. PE. Now, guys, they have a great moat, but the growth is going to slow as time goes on. So I'm going to call it 14, 16, and 18 PE. And price of free cash flow. And for my final desired return, I'm at 12.5%. And the reason being is you can get a ETF for 9 or 10% return. So in order to get some sort of margin of safety and a reason to buy an individual stock, put in 12.5 or higher, it doesn't matter. I just did a video where I did 15% on all 3 stocks. So what do? We hit the analyze button. The stock is currently at 147.81. Scroll down and low of 60, high of 113, in the middle of 80 to 85. Now you might sit there and go, oh my God, this is impossible. First off, I'm going to add it to my watch list at 104.9. Notify me. This software will send you a message on the app and through email telling you Apple hit that price. And for those of you who think there's no way it'll hit there, guys, it went from 180 to 130. Go look at our past videos. We literally had people saying, oh my God, you're so wrong on this. It went to 180. It will happen. Stocks will fall a lot faster than they'll go up. So if you like this video and you want to learn more about our 8-pillar process, click the link above. Don't forget to subscribe to the channel. Thank you very much.